Stop what you're doing. Literally, if you own NVIDIA, AMD, or any AI-related stock right now, you need to see this 5-model valuation breakdown. Because the biggest bottleneck in the AI revolution, it isn't the GPUs, it's the memory. Last week, I ran the fundamentals on an under-the-radar AI stock that is secretly powering the entire global tech buildout. I ran it through 5 different valuation models and 2 legendary investing checklists. And honestly, what I found shocked me. Look, I get it. Most retail investors are absolutely terrified of buying into an AI hype bubble right at the very top. That is a completely valid fear. But what if you could invest in the essential plumbing underneath it all? Welcome to The Explainer. Today we're unpacking Rambus, ticker symbol RMBS.
Now, this company is doing something that should theoretically be impossible. They are a hardware company running gross margins of 79.73%. No, that is not a typo. To put that massive number into perspective, that is a hardware business operating with the financial DNA of a capital-light software giant. It's basically the ultimate analogy, right? It's exactly like selling shovels during a gold rush, except these shovels cost you almost literally nothing to make. How on earth do they do it? Well, they achieve this software-level profitability by owning the critical intellectual property that the entire semiconductor industry absolutely relies on just to function.
Which brings us to a literal multi-billion-dollar question. Is this the ultimate hidden gem in the AI infrastructure space, or is it a hype-driven trap just waiting to catch unsuspecting investors who are late to the party? By the end of this explainer, you'll know exactly if RMBS is a Peter Lynch trap, a Warren Buffett buy, or something else entirely. Plus, I'm going to give you a clear, actionable framework that you can steal to analyze other high-flying tech names. So let's dive right into the core of their business and see what actually makes them tick. So when massive tech giants, the hyperscalers, design their custom data centers, they run into a serious, real-world physics problem. Think of a cutting-edge AI accelerator from NVIDIA or AMD as a massive turbocharged V8 engine. Sounds great, right? But that engine is completely useless if the fuel pipe, which in this case is the memory, is just too narrow to feed it. That is exactly where Rambus comes in. They design the critical memory interface chips and controller IP. They essentially build the digital highways that allow advanced memory architectures like DDR5 and high-bandwidth memory to actually keep pace with these supercomputers. And by holding a mid-40% market share in DDR5 components, they are literally the toll booth on the AI highway. Because they own that crucial piece of digital real estate, their financial profile has gone completely parabolic. Just look at the trajectory of their EBITDA here. It has been rocketing upward with just incredible momentum. We're talking $124 million in 2022. By 2023, that surged to $202 million. And for 2024, they hit $226 million. We are looking at an operating income that has practically tripled in just a 2-year window. And let me tell you, that kind of velocity is exactly what gets institutional investors incredibly fired up.
But as you probably know, rapid growth often comes with really dangerous debt, especially in hardware. But not here. Rambus operates with an absolute fortress of a balance sheet. They are sitting on a massive $786 million in net cash and marketable securities, towering over total liabilities of just $139.9 million. Operating in a net cash position like that is a massive strategic advantage in the fast-moving semiconductor space. It basically allows them to relentlessly fund their own research and development, like recently producing the industry's fastest high-bandwidth memory controllers without being at the mercy of outside lenders or, rising interest rates.
And look, when a company starts printing this kind of cash, it attracts heavy hitters. Check out this recent SEC filing. Rambus just brought in industry veteran Sumit Ganeja as their new chief financial officer. And Ganeja isn't just some numbers guy. He was the divisional CFO of the data center segment at Advanced Micro Devices, and he's held senior finance leadership roles at Western Digital and Intel. Bringing in a sniper who deeply, fundamentally understands the capital allocation of the complex AI ecosystem, that signals that Rambus is gearing up for disciplined, highly profitable scaling over the long haul. But the validation doesn't stop at the CFO desk. Former AMD president Victor Peng recently took a seat on the Rambus board of directors. Now, Peng previously ran Xilinx before AMD acquired them. He's a deeply seasoned operator who has lived inside the exact customer base that Rambus is trying to sell to. An executive of Peng's caliber doesn't just take a board seat at a mid-cap semiconductor company for fun, right? No way. It is a massive vote of confidence in their custom silicon strategy, and it tells you that the absolute biggest players in the industry view Rambus as foundational.
Okay, but before we go crowning this the perfect stock, we really need to hit the brakes and look at a reality check. Because no company is flawless, and Rambus is definitely showing some friction. While their physical product revenue, the actual chips they sell, jumped a very healthy 15% year over year, their royalty revenues told a very different story. Royalties are essentially those highly profitable licensing fees they collect just for letting others use their designs, and those slipped from $74 million down to $69.6 million. Consequently, non-GAAP operating margins compressed from 46% down to 42%. Management is calling this a strategic R&D investment, but honestly, it's a visible crack in the armor that we absolutely have to monitor.
And that crack leads us directly into the valuation shock. Rambus is currently trading at an eye-watering trailing price-to-earnings ratio of 80.1. Let's put that massive premium in perspective. At the end of 2023, that PE ratio was just 42.9. Driven by this wild AI euphoria, the stock went on an absolute tear, rallying over 166% in a single year. Right now, the market has priced this stock for absolute perfection, significantly outpacing the actual growth in their underlying earnings. And we all know what happens when you pay an 80 PE for a company. Any slowdown in growth can lead to a severe and immediate correction.
This premium price tag is exactly why analysts at 24/7 Wall Street issued a highly cautious note. Their thesis is pretty blunt. Valuation is stretched way ahead of fundamentals. They point out that a company heavily reliant on IP is incredibly unlikely to scale into a multi-trillion-dollar valuation on intellectual property alone. Now, yes, Rambus has successfully pivoted into designing physical memory products, which now make up about half their revenue. But building and scaling a physical hardware business, that takes considerably more time, labor, and capital than simply licensing IP out to other builders.
To complicate this valuation picture even further, we have to look at what the insiders are actually doing right near the stock's peak. The company's chief operating officer, Sean Fan, recently disposed of a massive block of nearly 38,000 shares at roughly $151 a share. This stands as the largest single insider transaction in the recent window. Look, executives sell stock for plenty of personal reasons. Maybe they're buying a house or paying a huge tax bill. But taking that much capital off the table near a 52-week high, that is a glaring data point you simply cannot ignore when assessing your risk. So when you plug slipping royalties and heavy insider selling into the valuation models, the math gets brutal. The fundamental analysis by 24/7 Wall Street resulted in a firm sell rating with 90% confidence. Against a current trading price of roughly $145, they modeled a price target of $118.67. That implies an 18% downside risk over the next 12 months. The forward valuation is priced so incredibly high that it leaves zero room for error. If they miss earnings by even a fraction, that downside target could hit very quickly.
So, let's put it all on the scales. This is the ultimate tug of war. On the bullish side, you have a company boasting nearly 80% gross margins, absolutely zero debt anxiety, and deeply embedded IP in the most critical bottleneck of the entire AI buildout. But then on the bearish side, you are paying an agonizingly steep price of admission with an 80.1 PE ratio, all while watching their most profitable revenue streams slip and key insiders take their chips off the table. It is a textbook high-risk, high-reward scenario.
Ultimately, you have to ask yourself, are you willing to pay a massive premium for a perfect narrative? Or is the smartest move in the AI gold rush to wait for a pullback on the companies selling the shovels? Memory bandwidth is undeniably the new oil of the digital economy. But remember, even oil has a price ceiling. So, what's it going to be? Is Rambus a foundational cornerstone of your portfolio, or a falling knife just waiting to happen? That is the puzzle you have to solve. Thanks for joining me on this explainer, and I hope this framework gives you the edge you need in the market.